Okay, I think we will go ahead and begin. Welcome to this Trump won what now? The post-election market outlook with myself, John Hardy, Chief Macro Strategist at Saxo, and you, Blue Putnam, PhD economist, former chief economist with CME Group. And we do thank CME Group for helping us collaborate here. As you can see, it's a bit dim over there. You're sitting in the dark, I guess, still in the early morning hours in the U.S. I'm coming at you from Copenhagen in Denmark. But thanks for joining, Blue. And we have a couple of practicals to get out of the way. First of all, let's look at the usual disclaimer. This is simply a presentation of the thoughts that I and Blue have on the markets, and nothing should be taken as a direct trade recommendation. Please, if you're looking for how to reach out to Blue, where you can find him, maybe talk a little bit about yourself, Blue, and where folks can find you.
Yeah, they can find me on LinkedIn. That's probably the easiest place.
Yeah,
You can see my research on what the Fed's going to do and all of those things on my website.
great.
All interesting.
At
Happy to be here.
BayesianEdge.ai.
Yes.
Cool. All right, two more things. There is to the upper right of your screen, there is a handouts link, hopefully. And there you can find a link to the PDF that you can download of the slides if there's something you'd like to look at later or pass around to any contacts you might have, as well as a questions section there. And feel free to pop in a question at any time while we're presenting. If we're lucky, we'll pick it up while we're on the slides themselves, and try to answer those. But certainly in the roundup and the Q&A at the end, we'll try to pick up those questions. All right, as for what we are going to talk about today, just a very brief rundown of the scale and impact of Trump's victory here, and not really just a possible, but an almost certain now Trump 2.0. By Trump 2.0, we mean the control of both houses of Congress. There are still a few House elections that have been called, so we'll get to that in a moment. So Trump 2.0 meaning full Republican control of Congress. That's really critical for the full Trump agenda to be realized. We'll look at the market reaction thus far, both in stocks, reactions abroad, specific sectors, the yields, and in currencies. And we'll dive into where we're going from here now that we have a Trump 2.0, issues like the deficits, where we are in the U.S. economic cycle and the U.S. economy, and now that we know the outcome of this election, how it'll affect those things. So we have a big election win by Trump. What does it look like? It is a staggering scale, this victory. It surprised at the very far end of what certainly was expected in the polls. The betting markets, it turned out getting it right, at least for a time before the odds got really weird right up to the election. If we look at the scale of Trump's popular vote victory, this is the first time in the 3 elections that he's won. These are not the full final totals, but he is going to win by at least a couple of percent once all the California and other votes are tallied out there. The strongest Republican victory, I believe it was since 1988, and the first time the Republicans have received a majority of the popular vote since 2004. So Trump has a strong popular mandate. That's the short end of the short part of the message there. Senate, a clear Republican majority. There are 4 races yet to be called. It looks like at least 2 of those will go to the Republicans. It means, I guess, Blue, on this one, it kind of means that you don't have, when you have that bigger majority, there's a little bit less likelihood that one senator or 2, like was the case during Biden, can sort of play a kingmaker and require really significant changes to get measures passed through Congress. Isn't that how we should read a large majority in the Senate?
Absolutely. It does mean that even 1 or 2 senators can't control the agenda. That was clearly a problem for Biden with West Virginia Senator Joe Manchin.
Yes.
He did not run, so he was replaced by a Republican. That was one of the seats the Democrats lost. But yeah, the point is well taken that with a couple of seat majority, then you have room, and no one senator can play kingmaker. This gives McConnell much more power, and he will control the agenda.
McConnell being the
Senate
Senate
Majority
Majority
Leader.
Leader in Congress, or sorry, in the
Yes.
Senate for the Republicans. Great. Okay, and then the House, it's still remaining. So we have, it looks like 395 of the 435 tallied. I've seen on the screen here just a little while ago that four more have gone to the Republicans. I circled, I think it was what, 7 seats here. That I was just looking at the tallies. It looked like these were obviously going to go to the Republicans. And if they just get most of the remaining ones, they're already leaning for themselves. They are going to get a majority. The question will be, how strong is that majority? All right, now let's look at the election impact on markets. And Blue, you put this together, and maybe talk us through just the really the broad outlines of why the Russell 2000 smashes it with this huge gain relative to the Nasdaq and the S&P, and then we could also talk to the European opposite reaction.
Yes, the Russell 2000 is the small cap index. And these are really small companies, but they are largely domestic companies. They typically don't have a huge international business. And that means that they're the ones that'll be protected if tariffs are raised. So all of the U.S. companies get a positive boost from potentially lower corporate taxes. So they're all up. But Russell 2000 led the way because that's the index it probably benefits the most from higher tariffs. So that's the story there. Europe, the story is a fairly simple that they don't win, they lose in the tariff war. And so
Exactly,
there
and
you have
and I
the year.
wonder as well, and we'll talk through that later as well. I think there's a geopolitical element on top of the tariffs with the Russia-Ukraine war, etc. And there's already been some huge changes going on politically in Europe. I'll get to that in a moment too. And then we have so not only the big move for small caps relative to the broader and general rise in equities, we had the financials just absolutely exploding higher. I mean, these are very large companies. Let's look at like J.P. Morgan, gaining 11%, a staggeringly large gain, and that is, I guess, on the deregulation hopes for the financial sector from a strong Trump win here.
Yeah, it's both deregulation and again lower corporate taxes, but the deregulation part's very important. The banks are don't want to hold more capital than they think they need. The Federal Reserve has been talking about raising those things with raising capital requirements with some BIS regulations. That's going to fade away with this. So that this is definitely a pro bank move here, and they certainly went that way.
Right. Then we look at different themes, other parts of the market. We noticed Saxo maintains a series of themes that are related to technology, trends in the market, specific sectors that have a lot of investor interest. One we established quite some time back is cybersecurity. We noted it was the best performing of our sort of thematic investing, sectors that we've put together, or themes that we've put together. And then we have, I don't know how much you want to comment on this, Blue, but we have this tremendous gain in Tesla. Clearly, Elon Musk wading in a big way into the markets with over $100 million contributed to the Trump campaign. My sense is that the jump is, well, it's a knee-jerk jump, but it's also, could there be some practical reasons why this could be good for Tesla? Because with that, Mr. Trump being quite transactional, not only in geopolitics but in politics, I would argue there could be a seat at the table, perhaps for Tesla in the regulatory environment when it comes to opening up for the ability for fully autonomous vehicles to operate on American roads. Um, but that is part of one of the supports for Tesla's valuation is the idea that they are going to dominate that market. Clearly, it's not for their business, their car selling business only. I don't know if you wanted to add anything to that, Blue. It was just one of
No,
those
that's right,
remarkable moves.
it's a big move, but we do know that EVs are not as popular as many automakers thought they were going to be. Hybrids have picked up a lot of that slack. So, to look at Tesla, I think this is largely an Elon Musk move. And as you said, a little bit with the robo taxis. That will probably take a long time too. They have started in a few cities, I think three. But it's, let's just say consumer resistance is going to be hard to overcome in a couple of places. So,
Yeah, there's consumer resistance, and I think as well there's political. It becomes political to own a Tesla. I think is one of the risks to the brand. That can go, of course, both ways. Some could say that they have now a more favorable opinion of Musk and are more likely to buy a Cybertruck if you're a MAGA type than before. But on the other hand, especially abroad, I think of a place like here in Denmark where Trump is extremely unpopular. If Tesla is seen as as a sort of a an emblem of supporting or boosting Elon Musk, then there may be the opposite effect. And of course, they would not want to own a Tesla. There's been some
Yeah.
support for that in some of the developments and sales here too. So I think it's an interesting two-way sword, two-edged
Oh,
sword
it
on that one.
is, and you're quite right. We've had, when Tesla originally came out, you had more of the environmental people buying the
Mm,
Teslas, wealthier environmentalists,
yeah,
and now you've flipped because of Elon Musk's attachment to trust Trump. So
exactly.
it's I think if you're looking at his regular car production, I think that stock is you can't really justify that full move. But if you've just your 100 million plus has got you a cabinet position, well, then we'll see. And the U.S. was never going to import a lot of Chinese EV vehicles under anybody. That was not going to happen. So that's a neutral there for me.
And as well, they already even the Biden administration. We talk about this, these moves to see China as a rivalry in trade and in key strategic industries. We saw in the first or not the first Trump administration sort of cementing this, and Biden continued a lot of those policies, and even slapped, I think it's 100% or 110% tariff on Chinese EVs. So that theme is here to stay, and it will be here to stay in a big way under a Trump 2.0. We can assume.
Yeah, that the China policy is one of the few bipartisan policy issues.
Definitely. One thing that's not bipartisan is support for the green energy space, renewable energy, and this was certainly our worst performing Saxo theme of those that we have put together. You can see some of these individual performances on one day here on the list. In fact, if I'm deft enough here, I can pull up the laser and I can kind of point it out here. So this column here, the one day performance, and this in phase energy was actually the second worst performing stock on the S&P 500 for yesterday, a day that saw the broader market up. Only one that was worse is Supermicro, which is a beset with an accounting scandal, where it's accounting. It's been accused by a short selling outfit of cooking its books, and just its own auditors said, "We quit. We don't want to sign off on this company's reports anymore." So that's how bad that company is doing. And the second worst was one of these alternative energy providers. Vestas is the Danish wind energy giant, and they also saw a miserable day. Unfortunately for them, just a couple days after they reported earnings, which were also bad. So that company has really cratered. They do a lot of business globally and in the U.S. as well, and we can expect that a lot of those subsidies will be highly, targeted by the Trump administration for cutting. A bit of an irony, I guess, there as well in Tesla, because they've historically had a heck of a lot of support from from subsidies for EVs. And then Blue, we have the reaction in Treasury yields. How much of this do you attribute to the Trump trade? This is the 10-year yield, by the way, which kind of backed up from early October. Unfortunately, the months are not marked here, but the approximate start of this move was early October and just the other side of the election. How much do you attribute to the Trump trade, and how much do you attribute to a creeping sense that maybe we're not seeing a hard landing or even a soft landing, and a report or two from the jobs report or two that was quite strong.
Yeah, no, it's definitely both things going on. The if you're going to have a no landing, and the U.S. economy is going to be, say, a 2% real GDP economy, maybe a 2.5% inflation economy, you add those two numbers up and you get 4.5%, which is not a bad guess for what the U.S. 10-year Treasury might trade around. But the move in equities and the prediction markets for Trump was also highly correlated with the move up from. So I would give that about, I don't know, 60% the economy and 40% the election. It does have impact, particularly on mortgages. The 10-year Treasury yield is the benchmark that sets the stage for more 30-year mortgage rates, and the mortgage rates will be going up to reflect what's happened in the Treasury market. So that keeps the U.S. housing market in somewhat of a frozen state. So that's not as good for the economy. Yeah, you're muted, John.
And there's talk that, sorry about that, and there's talk that and justified talk that with those 3% mortgages that were available during the pandemic, people refinanced then are almost captive in their own homes because it would be so much more expensive to move and refinance at these, I guess there's around 7% rates these days.
Yeah, no, that's exactly right. So the supply of pre-owned housing, as you might say, is very small, and the new market, costs are higher, and the construction, the builders have done well, but they haven't made up for the whole difference with the locked in on the existing homes.
Yeah, and very interesting. Just for me, this is a really key indicator. This, I mean, U.S. rates are the price of global money, and we'll get to the dollar in a moment. But rising U.S. rates and rising U.S. dollar are toxic for global financial conditions, emerging markets, etc. So, this is to me, this is kind of a macro flashing warning indicator. May not mean something that much for those that are chiefly focused on an equity only portfolio, but to me, if it's rising into this 4.5 to 5% zone, I think it just becomes something that's difficult for the equity market to swallow. And then we have the foreign exchange reaction, so the U.S. dollar, and this is just to highlight what happened. So really sharp move in the euro lower. I was quite taken aback there. Often it's the Japanese yen that's the most sensitive because of its sensitivity to U.S. Treasury yields. But this was an equally large move in absolute terms to the Japanese yen move. There are two angles to that. So, Blue, you pointed out the weak European stocks, and we saw specific European exporters like German car makers doing quite poorly. The concern there being quite obvious on the tariffs side of things. But I wonder as well if this is an indicator of concern about the sort of the geopolitical impacts of a Trump that is just not as committed to NATO, the security umbrella, continuing to be sort of pulled away from Europe and the need for Europe to get its act together on the security front, just casts a shadow over the entire European project to a degree. Also with France and its dysfunction politically and austerity needs there because of the large budget deficit. So a really big move.
Yeah, the geopolitics definitely played a role in that. In the rising bond yields, you also had expectations of how low the eventual federal funds rate might go on the short end, move up a little higher too, supporting the dollar. So there were like maybe three different things working
Yeah.
against the euro on the post-election results.
And you actually had European rates lower, at least the first day of trading. They were headed lower as well. Presumably on the impact on European growth if some of these key export industries were impacted. On the flip side, it was very interesting. The Mexican peso, supposedly supremely sensitive to this election, it got the worst case scenario. It did sell off sharply. You can see this move down here, and yet the Mexican peso recovered by the end of the day. I guess it just speaks to that sometimes the markets can over anticipate things before they unfold. But certainly one to watch, the Mexican peso, because um, with Trump tariffs, I presume, Blue, that the big issue is whether it's China, whether it's whoever it is, an American manufacturer, it will just be more difficult to place your production facilities in Mexico and then expect that you can, NAFTA-wise, export those into the U.S. without some kind of a tariff penalty.
It'll be more difficult, but Mexico and Canada still do have the trade agreements, and so they're at least a little bit insulated from where the tariffs might go on the rest of the world. And so nearshoring remains a little bit of a theme there.
Right. Okay. Let's look at where we are on the Trump 2.0 impact, potential and eventual on the U.S. economy and markets. And this is where I really want to get into some of your thoughts here. And as you indicated, we had a mid-October sort of update on where things were ahead of this election and talking the different scenarios. You've indicated you're very much in the no landing camp right now in the U.S. economy. You're in good company. I think I saw Stanley Druckenmiller out today saying the same thing. Hard, soft, or no landing, you're in the no landing camp. And that seems to be edging where we're edging towards as you indicated, the Fed expectations for rate cutting continue to kind of get a little bit more shallow. But how has the Trump 2.0 outcome here influenced what you see?
Well, we won't really know until we find out much of Trump's tariff policies and immigration policies result in things. But the economy today in the U.S. is doing fine. We had a weak October jobs report, but that was because of two hurricanes and a major strike in the aircraft industry. All of those things are going away. So the forward look on where jobs and the unemployment rate is quite robust. Now it's slower than the post-pandemic job surge. So the U.S. Jobs market isn't going to be growing as fast as it did in 2023 and 2024, but it's still, a 4.1% unemployment rate is a very low rate historically. The question going forward is, if the tariff policies are implemented, high tariffs around the globe from the U.S., would that cause any kind of global repercussions? You're going to have tit for tat reciprocal actions back on the U.S., and so I distinguish between the long run tariff impact, which could be a little bit inflationary, and the short run impact, which is a shift from a lower tariff to a higher tariff regime. And that could disrupt supply chains. It could disrupt imports and exports around the world. And that could actually be recessionary. But we don't know how fast the tariff policies might be implemented. We don't really know much until we see what the cabinet looks like and how this debate develops. But the risk of a recession coming from tariffs and a little bit from immigration, because those workers they count for a lot in the U.S. economy, particularly the growth of the labor force. Those risks have gone up. So I'm not as inflationary in the short run as most people are, and I'm a little more worried about the economy. But if I look at it today, it's just fine.
Okay, so it's a very interesting take on things. Obviously, when you see the enthusiastic reaction as you've done, that sets up, you would think, a very positive growth story, and yet you're touting a slightly more negative spin on things. And to the point of this slide here, where we talk about the Republican sweep scenario and what it means. So combining that, the tariffs isolated in the meaning for the U.S. And for U.S. companies in an isolated sense might be good for some Russell 2000 companies, but you argue that well, let's remember the 1930s when you have the tit for tat and you have this uh, global globalization or deglobalization and even fragmentation, as some call it, a risk with I guess trade hostilities a key part of that. So it's really that combination, I guess, of the tariffs and the geopolitical implications of those tariffs, isn't it?
Yeah, it certainly is. And again, I think you have to distinguish between where the long run would be in a high tariff world, but the short run is going from lower tariffs to higher tariffs. And the short run can be disruptive. It may only last a year or two, but that disruption can slow the whole world growth down. And that's what we'll just have to look at and see how these things get implemented or not implemented. But it's definitely a risk, and it's a much higher risk than it was 2 days ago.
And I'm struggling to recall the scale of the Trump tariff, the actual revenues you saw
Oh,
from these, but it was on
revenues.
the order of a few tens of billions, right? On an annual basis, is that scale
Yeah,
approximately right?
the revenues from tariff increases are not going to make much of an impact on the budget. It's just not there. You can only impact the budget by changing taxes or spending in a much more major way. But tariffs do, they raise a little money. I mean, if you go back to the 17 and 1800s, that's how the U.S. raised all its money. Uh, we had a little bit of an income tax in the Civil War, and then that ended, and then we have 1911, 1913 that we started the income tax. So, but now the income tax and the corporate tax that's the revenue, and tariffs going up to 10% or higher is not going to make a dent.
Right. We've kind of run through the deregulation, but actually on the geopolitical side, so I think it is absolutely not a coincidence at all. So we talked about the impacts for Europe, the negative reaction in the market, but not at all a coincidence that we see a sudden snap elections, which are rare, by the way, in Germany, just a day after the U.S. election. So what's going on there? Clearly, in an environment where the security umbrella is being pulled away from Europe, and an environment where Germany's whole economic model is under siege from it being cut off from those cheap Russian imports that were driving its export machine. And then you have the competition from China and its EVs for its massive Das Auto, the huge auto industry there. I mean, existential threat to Germany here. You see the government falling very soon. The finance minister was fired for not being willing to expand lending. So he's of the FDP, which is traditionally more sort of free market uh, party than the Social Democrats. So I think things have been accelerated in Europe in terms of the policy response there, and it actually gives me a sense that the if Europe is going to find its bottom of its crisis moment and move forward, this has actually stimulated that because of it's become such a big issue for Europe to have this outcome. I don't know if you have any thoughts on Europe as well, but I just want to put that in there because it's like a developing news item that has just swooped in the last 24 hours.
No, it's very important. And, you know, the U.S. is not alone in any way, shape, or form in being more isolationist, more protectionist, and more anti immigration. That theme is certainly true in Europe. And, you know, the Trump victory just plays into giving that a little extra momentum. And so, you know, for a free market economist, this is gives me worries about the global recession that could come if everything moves too fast. But it's not happening yet.
Right. So let's get back to our slides. I really wanted to get to this point here because I thought your comments. So we had a brief discussion before we got going here about both the lame duck Congress and the debt ceiling and issue and so on. And I must say, Blue, when you're reading about all of whether they're pundits or whether they're people with sort of a sober assessment of what Trump policies would be, they take sort of the maximalist approach, saying, "Wow, he's promising all these goodies. That means he'll implement all these goodies, and it would blow a massive hole into the budget deficit." But I think it seems that you have a slightly more cautious stance, or not a more cautious stance, but a more nuanced view of how this could shape up. That doesn't necessarily mean we're going to have just complete and utter fiscal profligacy under a Trump 2.0. Walk us through why that's the case.
Well, there are two big issues that you're going to hear a lot about. The U.S. government has a funding deadline of December 15th where Congress has to pass appropriations bills. They will probably just pass what they call a continuing resolution and kick that can into the next year for the next Congress. But it still may be very contentious. And there will be subsets of the Republican Party that want to immediately get some spending cuts out of that. So we'll see that debate. The debt ceiling is a little different. The debt ceiling has been suspended. It goes back into effect on January 1st at the current level of debt, 35 trillion, give or take. Um, Now, that means that the new Treasury Secretary, whoever that happens to be, will use what they call emergency measures to curtail spending, and that puts that particular debate or crisis, if you will, into June, July, August. Senator McConnell, again, who will be the Republican majority leader in the Senate, has always never wanted to have a debt ceiling crisis. So the House will be the issue, and they are give or take 20 members of the Freedom Caucus that are pretty extreme on not wanting to raise the debt ceiling under any conditions. So you still may have a House that needs to get some Democratic votes to get through this. But I think they will. I think the risk of these debt ceiling and funding deadlines are no longer whether they're going to get done, but the risk now, or the concern now, is how much spending is cut or how much spending is constrained. Now we're really talking growth here, constraining the growth of spending, and what that does to the economy and to the budget and so forth. So it's still going to be a very vigorous debate, but I think it's going to be about spending. And you're going to hear a lot about potential cuts at the U.S. Department of Education, things like that. But, the big issues are the Social Security and Medicare, and that's politically, that's hard to cut.
Yeah, that's toxic to wade into that territory and talk about cutting Social Security or those entitlement spendings is virtually impossible, and that means that as a percentage of the budget, it's become the dominant portion of the budget, the sort of non-discretionary spending, I think it's called, and that means that the actual discretionary stuff is kind of shrunk as part of the overall budget. So it becomes very difficult to find something to cut, and I will be really interested to see if they think they can do something there, especially if Elon Musk thinks he's going to be appointed to what was it called, the Department of Government Efficiency, and entirely get rid of U.S. debts. That's going to be a growth killer if he thinks he can do even a small portion of
Yeah,
that.
and the fastest growing piece of the budget deficit is actually interest expense,
Yes, especially at these rates.
and and there's
Yeah.
nothing you can do about that. I mean, unless you take interest rates back to zero, and I don't see the Federal Reserve doing that.
Yeah, and you've illustrated here just the scale of the expenditures relative to receipts. And as we pointed out last time, this one here, you have the unprecedented Trump one administration doing the tax cuts at a time and expanding deficits from eroding federal revenues with tax cuts at a time when the economy, as you can see in the unemployment rate, was doing great with a falling unemployment rate. So supply side blowing apart the deficits or blowing up the deficits, and then the Biden extra fiscal sort of after the unemployment had fallen to the lows with the CHIPS Act and the Inflation Reduction Act at a time when that was not necessary, and then you know massive fiscal deficits when unemployment was really low. So it's very much bipartisan. So I'm very curious on this issue, Blue, how much they're showing restraint and being responsible with the deficit. I think it's really critical for financial markets because it'll impact, of course, the be all and end all, which is the treasury market.
Yeah, I mean, the budget deficit in the U.S. is like 6% of GDP right now. And it's really hard to see how you make that smaller if you're going to extend the tax cuts from the previous Trump administration, which they almost surely will. And, with interest rates higher, you just don't have a lot of room. Now, when I analyze the economy, though, to me, the budget deficit is affecting the new supply of treasury. So that's not good
Mm.
for the treasury market, but it has almost no impact on the economy. The economy responds to spending by the government and whether that spending grows or not grows. And that's where I'm really looking at these government funding and debt ceiling issues to see if there's any way they can constrain spending. I will take you back to 2011. We had a debt ceiling crisis in the U.S. in July and August, and they ended up with some very serious spending constraints that lasted for the rest of the Obama presidency, and you saw the budget deficit decline over that period. So they can do things on the margin, and we'll just see if they do. But it's spending by the government, the growth of spending that at least for me drives whether you want to be more or less optimistic about the economy, and the size of the budget deficit is driving how you feel about the supply of new treasuries.
What do you make of the argument, if any, somewhat similar to the experience in the UK up to the Brexit, and then in the years up to the first Trump administration, the rise of populism? You had the Fed running that incredibly accommodative policy to keep asset markets running to hopefully increase the wealth effect and therefore the impulse into the economy from that. At a time when you were just talking about the budget austerity there, that fiscal austerity driving sort of resentment that there was a huge portion of the population that was missing out. Do we have a new dynamic afoot here? Because inflation, I've got an inflation chart up, not right now, but I will in a second. Inflation chart up here on the screen. We're almost getting back to the pre-pandemic inflation levels. Um, I just kind of threw a ball of spaghetti at you there, but just it feels like we're in a very different environment that we have. It is really the fiscal that is dominating this time. The last time we had the fiscal austerity, that resulted in populism because of a combination of tight fiscal, loose monetary. Now it feels like we're going to have medium to loose fiscal, and and monetary just has to adjust. It can't really lead.
No, monetary policy is unlikely to be the leader. You're exactly right. And the Federal Reserve is going to have to start talking more about fiscal policy. They don't like to. They don't want to get involved in that debate. But their failure to understand fiscal policy and take it into consideration is what helped the inflation get started in the first place. We had $5 trillion of fiscal stimulus, and the Fed bought $5 trillion of government debt with their quantitative easing. So they were certainly complicit in the inflation surge, and they understand that, and they're not going to want to do that again. But we also have, a lot of tax cut promises from President Trump. He promised something to almost everybody,
Mm,
including expats.
yeah,
Uh,
that
and,
would be me.
but, how much of that gets done? Probably not very much. But the tax cuts of the previous Trump administration are now highly likely to be extended, and maybe even a small cut in corporate taxes. So that affects the equity market. That's part of the enthusiasm for equities, but not
Mm.
necessarily coming from growth. Corporate tax cuts do not increase economic growth. They raise stock prices. They don't raise investment activity.
A lot of that via the buyback function, as we saw under the first round of Trump tax cuts. I've put up on the screen here the Fed funds expectations for 2025. That's that blue line, currently at 3.75%. Fed policy rate is in the bands between 4.75 and 5, shown at 5 on the chart here. So we've marked down or marked up the Fed 100 basis points from where we were when we were expecting them to be the most aggressive in cutting rates. Ironically, that bottoms, or that is all that rise in the expectations. So for how little they're going to cut next year has come since they cut, or they initiated their easing cycle with a 50 basis point or 0.5% cut. Any thoughts on the FOMC? We have an FOMC up tonight. Are they just going to try to keep their heads down here? That's my feeling, that they want to just wait and see what develops next year, and they're sort of pre-committed to a 25 basis point or 0.25% cut today, and then good luck coming out with a coherent set of projections on the economy and on the policy rate at the December meeting when they have to do that.
Yeah, I think you're going to find that they do cut 25 basis points, a quarter of a percent,
Mm.
because they kind of box themselves into doing that with the
Yeah.
50. But when you listen to Jay Powell's press conference, if you tune into it today, um, you're going to see some incredible dancing. Probably the word data dependent will come up maybe a couple hundred times. Uh,
Yeah.
you know, and they may even say policy dependent, although he's unlikely to say that, just because they don't like to get involved in the policy debate. They do have to respond to it and what they're doing. So yeah, so I think the Fed will telegraph that they're going to go very slow. Still, the Fed is restrictive, and it will still be restrictive after cutting rates again. The inflation rates, um, services are still up in the 4.5% territory, but goods are at zero. So the actual inflation rate is around 2.5. And that's pretty, for an economist, if your target is 2 and you get 2.5, hey, I would declare victory. You get close to your round number, you've done well. So the Fed still has plenty of room to make incremental adjustments, and they'll probably signal that they're willing to do that if the data allows. Data says they can, and I think the data will say they can. But now the terminal rate, which was your chart on the end of December 2025, that's higher than it used to be. If you go back a couple of months, that was a 3% rate. Now it's 3.75. So a major change in where the market now thinks the Fed ends up. By the way, the Fed funds futures are not particularly great predictors of where the Fed funds rate will be a year or
Mm.
two from now, but they do measure the cost of hedging. That is the price of risk management, and so they're very, very valuable indicators.
Yeah. We have a question, by the way, from a Demetrius on Trump and the change to the Fed chairman. So Powell, we have to read between the lines because he's been very, diplomatic in saying he has no opinion on the policies of the government, or who inhabits the office of president, etc. But we have this feeling in between the lines that he's not a big fan of Trump, and the feeling might be mutual, even though he was appointed by Trump. So I guess we're looking at the final, what do we call it, 15 months until his term runs out, and I guess the 1st of February, 2026. So what kind of profile would Trump be looking for? Wouldn't it be somebody you think he could lean on if somehow Fed policy is getting in the way of making America great again, whatever that looks like? If for example, we're getting that growth slowdown that you indicate is a risk, and yet inflation is a little bit sticky, and the Fed doesn't want to go below a certain terminal rate to address that.
Well, President Trump clearly wants to have more control over the Federal Reserve, or at least influence. And so I think, the choice of the new chairman will probably reflect that. Now, it can reflect that in two different ways. You can get a person that believes in the independence of the Fed, but agrees with President Trump about where rates should go, which is basically lower. Anyone who uses a lot of debt, as President Trump did in his business career, always likes lower interest rates.
Mm.
So you may end up with that bias. Still, I think the Fed learned a lot about the quantitative easing period, particularly from 2010 to 2020, when the US economy was growing and they were still doing quantitative easing through a large part of that period. Um, it did not increase inflation during that period. You only got the inflation when you had fiscal policy and
Mm.
monetary policy combined. So I think the Fed learned a lot, and they will probably be a little more cautious as to how low they take rates. But they still, as I mentioned, they've got room to take them lower. But the new Fed chairman, um, Jay Powell is at the age where he probably wants to retire from this job anyway. So we're going to get a new Fed
Well,
chairman anyway.
not if he's a Greenspan, but I think there are a few. There are very few that are like Greenspan and want to hang on until they're whatever he was, 85 or something at the end.
Exactly. So it'll be a different Fed. It'll probably be a Fed that listens to the Trump administration a little more than it otherwise would be. But I think some of the independents will be retained, at least in the sense that they're not going to go back to zero rates. They might go to 3% or something, but they're not going to zero.
Yeah, my own opinion is that we're on somewhere along the arc of the Fed losing its independence for a time because we simply have to lower the real weight of this national debt we have in the U.S. And the only way to do that is via financial repression, and the Fed will be expected to serve as an instrument in that process at some point. The question is when this all unfolds. Is this for 2026 or for 2029? I'm not sure. I know.
And if you get lower rates on the short end, say you get to the 375, that doesn't mean you get any change in the 10-year. You just move the yield curve to its more traditional positive slope. And that's probably the most likely outcome. And now if you're funding the treasury, then you would shift gears toward shorter term maturities to do that. And the treasury has historically not been, they've been committed to providing liquidity across the yield curve. So, would they really want to go to heavy short term funding? I don't know, but that would be their choice probably, because I wouldn't count on a lower Fed funds rate giving you a lower 10-year yield. I would, the yield curve goes positive at least in my scenario.
Excellent point. Another question we have, a little bit related to yields, but sort of trying to link it with gold. Where do we see gold from here? Well, I think given my little a narrative on that, we're somewhere along the line or the arc towards a financial repression scenario, just because we need to get to a lower absolute level of debt in the economy, or lower real load of debt on the economy. That means financial repression. That means it's hard to get a return via fixed income. So I'm quite positive for gold for the long term. Short term, it's very volatile right here. We saw after the election it dropped quite a bit. Do you have any opinion on gold, Blue, and any
Yeah, I think the
relationship to rates?
well, my view on gold is that a lot of the rise over the past 2 years and last year in gold is countries around the world shifting some of their foreign reserves into gold.
Hmm.
And that is a geopolitical issue for me as much as an interest rate issue. The U.S. is going to become more isolationist, but you don't have an obvious choice away from the dollar, then you can diversify into some gold. And I think that's what foreign central banks around the world are doing. Some sovereign funds are doing, and I don't see that trend going away. I think you're going to want to continue to hedge your geopolitical risk, and gold is definitely one way to do that.
Yes, a very key point on the gold being bought by central banks, particularly China, and you could have a whole new podcast on what uh, fully fragmented global economy look like, and what is the new reserve asset if it's not going to be the U.S. dollar, because that is a really critical question for the long term that many are debating out there, especially as the U.S. Fiscal and debt position becomes more and more sort of fragile. Um, yeah, shifting gears quite a bit here. And maybe you have an opinion on this. So we had the Biden on the energy front. We have, of course, this incredible. Some have said it's like you found with U.S. shale gas first, and then the shale oil later. You've essentially created two new Saudi Arabias of energy to contribute into both the U.S. and global economies. Biden took the step to sort of cap the amount that could be exported for natural gas, at least via LNG. What do you get any sense of? And then the question here is actually a bit on the fertilizer, but I just wanted to broaden that out a bit. maybe tariffs, fertilizer, Trump policy on energy exports. This sort of mismatch in the world where the U.S. has just got such cheap energy inputs into the economy relative to a Europe which has been and badly affected by input prices in Russia spiking and yeah, there's just a whole I think a very interesting question for the world, not just for the U.S.
Yeah, and it's geopolitics come back in. So there's a
Yeah.
couple of themes here. On the geopolitics, Trump is likely to be a little more friendly toward Russia than the Biden administration was, and to the extent that anything can help in the Russia-Ukraine war, that would allow Russia a little more freedom on how to export again. And by the way, that would mean lower fertilizer prices.
Mm.
They're big. They used to be a big exporter of those things. The On the U.S. side, one of the big holdups on exporting the natural gas is permitting the facilities to liquefy and get the export ports up and running. It's very expensive to liquefy natural gas. You got to
Expensive
you got to
in dollars and in energy terms. You have to use a lot of the energy embedded just to get it liquefied.
Yeah, you got to keep it really cold. You got to get it cold and you got to keep it cold, and that's a lot of energy use. So now the flip side is once you've exported that natural gas to Europe, all you have to do is put it in a tank and let it warm up. So it's very cheap to turn it back into natural gas, but the
Mm.
liquefaction is a $5 to $10 billion expense. It takes 3 or 4 years to build, but the permit process has what the Biden administration has slowed down. The U.S. is pretty much exporting all it can right now, given the capacity of the liquefaction and the port facilities. But there is more coming on stream, and it will probably speed up dramatically over the next 4 years. So what that means, is that U.S. natural gas prices will slowly but surely be a little more closer linked to European and UK natural gas prices. So, if you're trading in the futures market, US Henry Hub becomes a more important global benchmark, even though it's not a global benchmark right now. But to the extent that the US expands its exports on a steady basis of natural gas, then you're going to have some customers in Europe of US natural gas wanting to do that hedging. So that's an upward pressure on US natural gas and a downward pressure on European natural gas. So it's going to be a very volatile segment.
So ironically, maybe a positive for Europe on that front if we put the two together. How about healthcare? Somebody asking a question on the healthcare front. What do you think the fate is? If I'm not mistaken, 2018, you had McCain, the senator from Arizona, who detested Trump, and the feeling was mutual. Basically saved the Affordable Care Act or the Obamacare Act, if I'm recalling that correctly, and then it couldn't be addressed again after 2018 because the new Congress was in the Democrats' hands. Is there anything big disruption, whether from growth, whether from consumer sentiment? Do you see anything on the healthcare front, policy-wise, and even sector-wise within health companies, with the fate of the Affordable Care Act?
Well, you're right to use the Affordable Health Care name. When it was Obamacare, it was definitely opposed by the Republicans, but as the Affordable Health Care Act, it's been embraced in many of the clients, if you will.
Mm.
The populations of many red states are heavy users. Um, One of the things the Affordable Health Care Act does is that an insurance company cannot deny you for a pre-existing condition. That is absolutely huge. And with an aging population, regardless of your political affiliation, that becomes even more important. So I don't think that the Affordable Health Care Act gets dismantled. I just can't see it. It's become too popular, even in red states, and it affects too many people. So I don't see that as a big change coming, and I don't think you're going to hear all that much talk about it in the new year.
Interesting. And then a question, you've seen a little noise on this front as well, and this is perhaps getting into the weeds a bit, but I find it a very critical question for the longer term, especially on climate, where I think I question the ability of many of the renewable energy sources to scale properly. A question on nuclear energy, and it was kind of interesting to see a couple of stories recently. Was it I'm forgetting now if it was Meta or Amazon or both, talking about building some AI data centers that would be powered by small modular nuclear reactors. and Microsoft helping to get a company to upgrade 3 Mile Island so it could also power a data center. 3 Mile Island being an old nuclear power plant. Any thoughts on nuclear at all, or is the U.S. maybe even behind on that front because it enjoys such cheap bounty of fossil fuels?
The U.S. is definitely behind on the front, but there is a little bit of momentum picking up, particularly as you mentioned with the micronuclear. Uh, we've been able to do this a long time. I mean, that's how you run a nuclear submarine.
Hmm.
But it can be made commercial, and that offers some interesting possibilities. Now, that's a decade-long stock market play here. It takes a long time to get these things up and running to it, and there's a lot of innovation that still needs to happen to make them commercially available. But it's one direction we could definitely see going in the U.S. and in some other places around the world. Nuclear is back on the table as an option, and Microsoft's trying to restart one of the reactors at that's a pretty that's a pretty interesting thing, given that that was a meltdown or a close meltdown.
Yeah. To be fair, I read into it. I think it was in one of the reactors that was simply shut down for end of life or whatever. It wasn't the actual one that
That's right.
melted down, but yeah, it's still remarkable. You see them willing to wade into that. Being associated with that name, 3 Mile Island. It's been so long since that happened. I guess they felt they were comfortable with it.
Yeah, it's a
Um,
big issue though. The amount of electricity that AI servers take is huge, and if it starts impacting the price of electricity that consumers pay, then you're going to have a very big backlash politically.
yes, yeah.
So that is a space very much to watch.
Especially the intermittency problem with renewable relative to like this steady high need from a data center, which nuclear is naturally the outputs is sustained at a steady level over time. I think I'll round off, Blue, with a question. I didn't prep you for this at all, so feel free to push back on it. I recall, and I was looking at this myself, and we recall back to the January 2020, the 2020 election, the January 2021 riots at the Capitol, et cetera. So there are all these fears around this transition to a new administration that Trump, if he lost, would declare another election fraud, and maybe even the opposite would be the case if Trump won by a narrow majority. It just seems like we've completely avoided this issue. But do you have any fears? It doesn't seem like anything on the election front, but do you have any fears politically or sort of um, socioeconomically from here with a Trump 2.0 administration?
I don't have any really fears, but I think the U.S. is still 50-50 or maybe 52-48 divided. That polarization is absolutely not going away.
Mm,
And the voter groups that brought President Trump back into office are very, very, white males without college degrees. It's a very different than, older females and things that are voting differently. So it's that those divisions do not go away.
mm,
What will be different is that, this is Trump's second term and he knows what he's doing. He will probably move faster. The cabinet will move faster. And so we'll get to see the economic and political reactions by his second and third year. And typically, administrations don't do well in the midterms, which
mm.
would be the 2026. So it looks like the House of Representatives stays Republican this time around, but it will be in play again in 2026 because that's just the history just tells us that midterms are tricky for the incumbent administration. So none of these things are new, and they're all alive and unfortunately very well.
Yeah, so if they have to get something done, it has to be in next year and the year after, before those midterms. In short, and that'll be one of the key questions, I guess, because it took a long time. Was it a year you said, or you indicated, or somebody told me that it took from the first talk of tariffs before they were actually implemented? Do you think they're a little bit more ready this time around to hit the ground running on tariffs since they kind of know it? And some of the characters I've seen associated with tariffs are recycled from the previous Trump administration.
Oh, they're definitely more ready. They ran into issues in the first Trump administration. They know what those issues are. They've got time to plan for them. And tariffs are The president has a great deal of authority on tariffs if he's willing to say it's a national security issue. He can override, if you
Yeah,
will. There's an out clause in most tariff legislation in the U.S. that, hey, this is the rule for tariffs, but by the way, if you declare a security emergency, you can do whatever you want.
yeah.
I'm simplifying a little bit, but he has tremendous authority to move more quickly, and he understands where the hot buttons are. And of course, the Supreme Court is now much more in his pocket. So, it may go through a few court cases, but chances are that these things do happen faster if that's the direction they want to go.
Great. Thanks for that, and thanks for that answer. And thank you so much, Blue, for taking part in this webinar today. All of the viewers out there, again, you can find the slides in the handouts. I forgot to tell you as well, this is recorded, so you can go back to home.saxo, find the webinars. Just Google it if you want to, and you'll be able to find the recording of it shortly. If you'd like to share the link with anyone, feel free to do so. So thanks to you, Blue, very much as our special guest here, and thanks to all to listeners and clients of Saxo that have listened in on this. And yeah, it's going to be exciting days seeing how this Trump 2.0 shapes up, and what we see from here until I guess is it January 20th, unless that's a Sunday, if I'm told. Then it's January 21st is the day that Trump will be inaugurated not next month, but in January. So,
Right, and thank you very much for having me, and thank you, CME, for having me.
all right. Thanks a lot, Blue. Bye,
You're
everyone. Thanks a lot for joining.